Good morning, my name is Przemysław Kwiecień. You're watching XTB Weekly Trading Webinar. Today we are going to talk a little bit more about China, a topic which we discussed briefly last week as Chinese stocks stumbled under pressure from Beijing, but today we're going to dive a little bit deeper and discuss whether China is a buy. So, we are looking at the markets where obviously there is a bull market nearly everywhere we look around, but China pretty much saw a bear market already, and the question is, should we take advantage of this? So we'll focus on this in the key part of our presentation. However, let's start typically from top news on Monday morning. US dollar under pressure last week after the Fed was in no hurry to even discuss tapering in a detail. So all they did was just saying that the economy was doing well. We'll discuss this in a minute. Reverse repo operations rise above $1 trillion US. Amazing over liquidity in US, and as a result, US indices storm back to the highs, ignoring all the bad news, because if there is so much money around, investors have to find some ways for this for these US dollars. The US economy seems to be booming. Chicago PMI on Friday rose to 73.4 points, whereas Asia is doing the reverse thing. The Chinese PMI is at the 15-month low. Japan, Korea, they saw slightly better numbers. However, they indicate record price pressures, whereas many countries like Indonesia, Malaysia, Vietnam, they sink on a mixture of COVID restrictions and price pressure. So that's a bad thing, I guess, because the US, why the US is doing so well is the economic stimulus. So obviously, with so much money around, with fiscal support, with the Fed printing US dollars, the money is simply flooding markets, flooding US economy, and as a result, all these PMI indices in the US are so high. But at the same time, we are getting this consistent message from the business that they are struggling with supplies, with price pressures, with employees, and it's not going to ease if we have issues in Asia, which we currently seem to have, and they are deteriorating. This week, the highlight is the NFP on Friday, and we will discuss this towards the end of our meeting today. On the right-hand side of this slide, you can see coffee, which saw a huge rally last few weeks. However, on Friday, prices stumbled after news that frosts do less harm than initially thought. So watch this market, because there might be more volatility ahead, as you saw back in 2013-14, where you also had a very strong rally initially and then some volatility before the market eventually went even higher and then plunged. So yeah, definitely market worth watching. Okay, so previous week, Fed and tech results were the key events, and the Fed, like I said, they did pretty much nothing. So all they said was that the economy has made progress towards these goals. These, it means full employment and price around 2%. And ironically, they said that inflation is on track to moderately exceed 2%. So this is really some kind of new language. The inflation in the US is at 5.4%. So how can you say that something that is 5.4 is on track to moderately exceed 2%? This is ridiculous, but it only shows that the Fed is completely in another world, and the markets see this, and as a result, they just enjoy the party until it ends. However, for the US dollar, the meeting was a disappointment, because there was some expectation that at least there will be a discussion on the date of a decision on what to do with the tapering, and there was none of this. So with US dollar positioning on the rise in the weeks leading to this July FOMC meeting, you had to have some kind of disappointment, and it was present. If you look at the US dollar, you can see that there was some kind of a rebound. These declines that were actually triggered by the June FOMC, they already were losing momentum, and yeah, the price managed to break out of this kind of wedge. We can draw it for you, and yeah, there was a breakout, and after the FOMC it got some additional momentum. So we'll see. At least right now the US dollar is in the defensive, and unless it's supported with this week's NFP on Friday, we can expect a bigger rebound to take place here. Okay, so the second story was the tech results, and obviously on paper they were strong, and in general they were strong. However, the major story is that despite these stocks doing so well in terms of results, definitely better than the most of the world, the valuations are still stretched. So even if you include these very high earnings, you still can see that, for instance, for Microsoft, price to sales, this is this purple line, is above 5, whereas it was consistently below 2 for during the whole first part of the previous decade. For Apple, it's above 7, whereas it hovered around 3. For Amazon, it's 4, whereas it hovered around 2. So yeah, for Facebook, it's a bit lower, but then again, Facebook only built their results throughout this period, so it's not really comparable. So the bottom line is that yes, these companies are doing very, very well. However, the valuations are still stretched. So if there is some major change in the policy framework, be it through inflation or the Fed policy as a result, or some global slowdown or whatever you can imagine, you could still easily have these valuations back to these levels, and there would be it would be shocking, right? It would be something you'd say that it's kind of natural. So it's good to have this in the back of your head. Okay, but let's move on to but before that, the US indices, as we already discussed, Fed and the results. Well, as you can see, still the bull market is doing extremely well. The S&P 500 on Friday, they just slightly pulled back on a slightly weaker Amazon quarterly results, and then today already, for no reason, pretty much, we're back at the highs. So no change. Last week we had this bullish reversal, more than like 2 weeks ago actually, and another one, and yeah, the trend continues to look extremely solid. So for now, at least, there are no clear reversal patterns, and for as long as you have this over liquidity, it really would need to take something very, very serious to change the sentiment for good. Okay, is China investment opportunity? So first of all, with China, which you can track using the CH and Comp CFD here, which is CFD based on Hang Seng China Enterprises futures, you can see that this is so strikingly different than what we see in the US. We actually see here a bear market more extreme than the one that took place in the initial phase of the pandemic, and the levels are not much higher. The reason behind this, what we quickly discussed last week, is that following a streak of tough policies on the internet sector, we had this very serious regulations on the education stocks that pretty much shut down their businesses. So the message for foreign investors was that the regulation from the Beijing will be much more severe than what you see in the US, where these tech companies are pretty much doing what they want. To add to it, rather than having this over liquidity what we see in the US, we had tightening in China, and you can imagine how serious it is for the market. You can see it in the US that investors ignore any bad news because there is so much money. In China, on the other hand, there was a tightening because Beijing thought, well, why would we support the economy when there is so much demand from abroad? Let's wait until they, deteriorate and we are in a bigger trouble, and then let's reserve these resources for this period. So obviously for the markets, it also has significant impact. And if you have a mix of monetary tightening plus regulatory framework which is not very favorable, then obviously the market impact is what it is. When you look at the valuations, you can see that Hang Seng China Enterprises Index is actually the only major index that saw year-to-year losses, which is quite striking looking at the gains that many indices managed to register. The valuation metrics look very favorable in comparison. However, if you compare them to averages, let's say price to sales for Hang Seng 2, price to sales for Hang Seng 10-year, 20-year average, it's about where it was historically. It's still better than most of the other indices, because let's take a look at Nasdaq. Price to sales is 5.6, where historically it was around 3. Earnings yield is 2.7, whereas historically it was 4 or above 4. So obviously it still looks better, but even more, Hang Seng looks very well technically where you look at the deviations from the average. So regardless of which average you choose, be it 100-day, 200-day, 500-day, you are around the levels that we last saw in March of 2020, and before that in 2016. These levels were even slightly more extreme, but on both of those occasions these were great entry points. So how to invest in China? Well, like I said already, the most direct source is this CHN Comp CFD, because you can additionally use a leverage of 1 to 10. Other than this, you can use ETF CFDs on slightly different symbols. I'm not going to go too much detail. You can check this in the analysis section of the platform if you want to read more about these ones. So the bottom line is that as a result of strong government intervention plus monetary tightening, Chinese stocks surprisingly are in a bear market in a very, very stark contrast to the rest of the world. Yeah, in the long term, I think if you look at the role of the Chinese economy, which is set to become the largest economy in the world during this decade, this looks like opportunity to expand your portfolio to the market that is struggling now, but might be very undervalued, and it will be important for a global economy in the longer term. So against the backdrop of all this craziness that we see on Wall Street, it looks like the Chinese market could present very decent opportunity. All right, let's move on and focus on the current week. This week, pretty much the focus is on Friday and the NFP. Everything that we have until that point will be just a preparation. We have the ISM indices on Monday and Wednesday, and the ADP report on Wednesday. With ISMs, obviously, we want to look at price pressures and employment difficulties. However, yeah, like I said, the focus will be on the NFP, because the NFP seems to be the only report that can actually force the Fed to do something quicker that they want. Obviously, the US labor market is not as simple as the NFP figure is, and if you look at it from the perspective of employers, you can see at this, you can take a look at this chart where the number of jobs available is at the record high. If you look at this from the household's perspective, you can see that the labor fund, which is the payrolls number multiplied by hours multiplied by hourly wage, it's also doing very well. The fund is way above the peak from before the pandemic, and it's close to the pre-pandemic trend. But if you look at it from the pure payroll number, which is the number of employees, it's still way below. And from the, you know, if you wanted to look objectively at the economy, you would need to weigh all these measures. However, as I said on many occasions, the Fed really doesn't. The Fed, what they want to have from here is an excuse to keep QE going. So they will be using this chart as an excuse to keep printing money, and therefore it's really crucial. The number of employees is still really crucial in this report. Yes, you should also pay attention to wages, because if wage growth accelerates, that it will add to the inflation worries. However, it is this number that needs to rise quicker in order for something interesting to happen in the markets. Because if it keeps rising at just a moderate pace, it will provide a good excuse for the Fed to be very slow with predicting anything. And also, like I said, with the US dollar, it looks like it is a last chance for a US dollar to return to this downward trend, because right now the picture is, it might be not extremely bullish, because we had this reverse on Friday and the market doesn't look extremely strong. However, unless the NFP provides a support, we can see a tendency for this market to move towards this upper limit of this very broad range. Okay, ladies and gentlemen, that's it for today. We see each other towards the end of August, because I'm off for holidays, but stay with our news section where my colleagues will keep you updated. So have a great time, and I wish you best of luck.